If you're watching this, you saw that I'm going to show you a high RR trading style and a high win rate trading style using true levels in price, and you are right. Okay, so what exactly are we going to use? Well, the secret sauce is this. Okay, in order to get high risk reward trades, you need the following. You need the skill to recognize true gaps. You need the skill to understand where your stop loss should be, and also you need the skill to know where to exit. So in this video, I'm going to show you all three: recognizing true gaps, understanding where stop loss should be, and the skill to know where you should be exiting trades. So stay tuned to find out. All right. So first of all, in order to truly recognize gaps, right? We are not recognizing gaps as imbalances, like any normal imbalance that you see in price, right? This is an imbalance. This is a fair value gap. This is a fair value gap. This is a fair value gap. This is a gap. This is a gap. This is not a gap. This is not a gap, so on and so forth. So how do you recognize the difference between a gap, which is a fair value gap, and an imbalance, right? So take a look at this. So when you are looking at fair value gaps, you need to have opposing delivery on either side, meaning a bearish fair value gap will be one that has a down close candle, up close candle, or an up close candle, down close candle. Okay. So there should be an opposing delivery on either side of the three pattern candlestick pattern. Okay, so this here is a fair value gap. This here is a gap. This here is a gap. That's a bearish gap. So that is step one in understanding the true nature of gaps. Now start a bearish fair value gap, let's say. But now the other one is this, a bullish fair value gap. It is one where in which you have opposing delivery on either side. So up close, down close, gap. Up close, not a gap, it's a imbalance. So if this is an imbalance, why is price reacting from there? Because it's not reacting from this, my friends, it's reacting from this. Why that? Because this is an inversion fair value gap. This fair value gap was used and then it got inverted through. That's a gap. Okay. Here, imbalance. What is price reacting from over here? Well, look at this. We react from this old fair value gap, we fail it, hit it here also, and price goes higher. That is a fair value gap. So this is step one. Now you have the skill to understand what true fair value gaps are. You're focusing on these opposing delivery patterns because they have some form of meaning. They represent the true change in the state of delivery. These are the gaps formed when price changed its state of delivery internally. Okay. So having said that, let's now try to understand where our stop loss will be. So let's just take a look at the ones that worked. Okay. So all these worked. Now, if you're buying, let's say you buy here, where's your stop loss going to be? Your stop loss is going to be below that middle candle there. Okay. Below that middle candle over there. Below the gap candle. Okay. Just in a bullish example. Over here, your gap is going to be below the gap candle. So in this case, what's the gap candle? This down close. So that is your stop loss. Okay, that is your stop loss. It is as simple as that. All right. So now you know how to place your stop loss for a bullish example. But for a bearish example, what's the case? Here's the case. Let's say this is your gap. We have one over here also. This is your gap, right? So when you're taking a sell, where is your stop loss going to be? Above the gap candle. Where's your stop loss going to be? Above the gap candle right there. Okay, that way you know that when price wicks or goes into it, you know that now that gap is invalid. But there are instances in which price actually, it just wicks you out and then it closes back down and then proceeds to go lower. Okay, in that case, you wait for price to close, take the same trade, place the same stop loss, boom. At least give it 3 tries, 3 attempts, and then you'll be good to go. Okay, so now you know exactly what you can do to recognize the gaps. You know what you can do to place your stop loss. Then what can you do for your take profit points? Yeah, it's like this. If you have and M5 gap, you will target M1 buy side or sell side. Meaning, if you take this here, yeah, there, we can clearly see that this is the left side of the curve. So on this left side of the curve, we know that this is the closest 1 minute buy side liquidity pool. This is your hunting ground for scalps. Perfect. Okay, that's your hunting ground for scalps. So let's take another look. Now we saw a bullish example. Take a look at a bearish example. All right. So on the bearish example, which is over here, we can see that this was a gap. Price came and used it. Okay. If this is an M5 gap, then I'm looking for one minute buy side. So if we divide this into half, or if we divide it between the buy side and sell side of the curve, we know that this is the sell side and this is the buy side. So on the 1 minute chart, we know that these all have been taken out, but price is still going lower. So over here, we have stack sell side liquidity. And on the 1 minute chart also, it will be stack sell side liquidity. So you can use this M5 gap, and you can target this M1 SSL. Okay, now you have a full trading model. Okay, now how can we turn this into a pattern-based trading approach? I mean, from a pattern-based trading approach to a logic-based trading approach. Shondi, you're speaking my language now, isn't it? Okay, what we will do, we will use my London macro. Here, remember the previous video? If you haven't watched the previous video, go watch the previous video about my London macro. All right, here, what's the situation? Here's the situation, right? What do we have? And I'm going to show you one example only. You can do the rest by yourself at home. Okay, in this example, right, we can see prices going up, leaving no gaps at all, but it's leaving imbalances, which doesn't matter to us. We want gaps here. Here's an inverse gap there. Why? Up close, down close, down close. It's a normal fair value gap. Price reacts and fails. So you are buying here. Okay, where's my thingamajig? Here it is. You are buying here. Stop loss is going to be below the gap candle. So going to be right there. All right. Now, your target is 1 minute buy side. So we know that this is the buy side of the curve. This is the sell side of the curve. 1 minute buy side obviously is going to be here because what? That is stacked stacked buy side. That's your TP. So let's see if this works out or not. So one stop loss. Don't worry. One stop loss. What we're doing? We are looking for the same setup. Same setup. All right. Watch. Here. You know that, okay, I have another inverse gap here. I'm going to buy here. Max 3 tries, okay? Max 3 tries because the risk reward is going to be big anyway. So stop loss will be below the gap candle there, okay? Same, take profit. Now let's see. Now you'll be taking parcels, of course. And let's see whether this holds on to the end of the curve. Now, if you put your trade at break even, it's break even. If not, then stop loss. So it's okay. Now, why is it reversing? I mean, you said, Sean, 1 minute buy side. Okay. 5 minute POI, 1 minute buy side. So 1 minute buy side means price has gone and taken it here. It's not going up there. What can you do about it? Nothing. Too bad. So you took major partial say. If it was me, I'll take 80% off, stop loss at break even, done. Okay. Now, let's take a look at another one. So let's go here. All the London sessions, let's see. Okay, now here we are. On this day, I can just say that the bias is bearish because I can see it with my eyes. Right, let's find out what we're looking at. This is our gap. All right, that's our gap. What is price doing? It's not even touching. So it's not even touching. What will I do? So me, what I personally would do is as it comes near the gap, I'm selling like this. I don't recommend you do that, but it's okay. And you keep your stop loss above the gap candle there. Okay, next stop is you're finding sell side. So of course, sell side is here. It's a scalp, Sean. Yes, it's a scalping model. Okay, now if you know what the larger time frame targets are, you can go ahead and do it, right? for instance, if you can say, okay, I want this side, so I'm going to turn this into a big trade. Let me see if it works out or not. So first of all, you'll be taking major partials here because your idea was a scalp. And secondly, stop loss will be moved to break even, and then you will see what happens next. Break even hit. Yeah. So that's why it's important to understand the overall context, which is this. So in this case, it's going to be a slightly larger one. That's okay. Uh, Otherwise, just skip the trade entirely. Okay. Okay. Let's look at one more, and then I know I said I'm not going to show a lot, but let's just go one more. Let's say from here. Okay. Now let's take a look. What's happening? Over here, the bias is bullish. Okay. But price hasn't taken out the Asian high there. So if it doesn't take out the Asian high, I'm not interested in buying as of yet. So what we will do? We will check and see if we have any inversions. No, we don't have any inversion just yet. Sean, why is that? Because take a look at this. This one here. This can be an inversion, but it doesn't have the candlestick requirements. So I'll check the 3-minute chart. If it is there on the 3-minute chart, then so be it. What do we have? We have this, and we have this, right? There. Okay. What will you do? What will I do? I will do this. Stop loss above the candle, because it's an inversion, right? Stop loss above the TP is going to be sell side. So up, down. So here, let's see if it works out, or stop loss. Stop loss. We go here now. That's okay because we have two. I prefer the first one, but I'm just showing you the variations. We go here. Stop loss above the gap candle, which is there. Same TP. Yeah. Okay, so of course I'll be taking major partials. Let's see if it hits full TP or not. Yes, it does. Okay, so that is very important. So now I gave you a full framework. You can choose to use it within the scalping nature of things, or day trading nature of things, swing trading nature of things, whatever it is, that's up to you. But this is a simple scalping framework that you can use to easily make money. And it would be even more easier if you have my bias prediction algorithm. Now, for example, if you look at today's price action on Bitcoin, I'm in longs over here. Pretty easy. Took it beforehand, of course, before the time interval, because I know what I'm doing. Uh, Nothing much to it. You can do things very, very easily. Get the bias, wait for your POI to hit, take the trade, know what your buy side liquidity pool is. And over here, you can see I have statistical levels that I can use to determine whether I want to keep my target here, keep my target here. John, why is your target here only? Because we haven't hit any manipulation level for now. So if you can go up, take buy side, come down here, hit this or level close to it, and then buy, then that would be great. Okay. So with that said, I hope you guys understood this video. I hope you found this insightful. If you do have any questions, you can definitely ask me on Telegram, or you can definitely put it down in the comment section below. Just to let you guys know, the lifetime offer for the algorithm is still running, and everyone loves it. You can definitely get it. You can definitely send me a message to get it, because the lifetime offer will no longer be there from 2025 onwards. All right. So with that said, Trade Easy is meant to make your trading easy. If that's what you want, if you want to stop losing with ICT concepts, this is the next best thing. I'll see you in the next one. Good luck and good trading. Bye bye.